This video is covering the sale of long-term real estate property. Let's take a look. Okay, so let's start here with the balance sheet. And I'm going to collapse a lot of this because we don't care about it. I'm just using this for demo purposes, this account. So first thing we see here, an other current asset is an escrow account. So that's the account held with the mortgage lender that holds funds to be used to pay insurance and property taxes. Next, notice buildings, the fixed assets. We have buildings, depreciation, improvements, land, landscaping. We're going to ignore the rest of this for purposes of this demo. The other thing we want to notice, let's get rid of all these current liabilities, is the mortgage and the mortgage balance there. Okay? So let's start by looking at the closing disclosure for the sale and what our journal entry is going to look like for the close. Where is my plus? Okay. Huh. For some reason it doesn't show here with it collapsed. All right, no biggie. Let's figure out another way to get here. Now let me just make it bigger for a second. Now I can see my journal entry. Okay. Okay, so let's go. Oops. Now I lost this. Let's see. Let's move this over here. There we go. Okay. So first thing we want to do, let's make this a little bit bigger. Is it gonna work? Yeah. Okay, first thing we want to do is zero out the fixed assets. So, looking at our balance sheet here, we have buildings. And we know fixed assets normally have a debit balance, so we need to go on the credit side to clear it and just needs to match exactly. We have accumulated depreciation. Let's leave that for last. What's going on there? What in the world? Okay, improvements 24,178. And land 60. And what else we got? Landscaping. I'm not sure I'd put that separately, but let's just say that's how it is. And then depreciation. And I'm going to put this as a negative. So that tells me here that that's my cost basis, right? 329,223. That's why I'm putting that as a negative there. If I were to just save this, let's just do this, save it, and let's change this date to the sale date, something like 8/26/25. Okay. Okay. So I'm going to save this. I'm going to refresh my balance sheet. And let's see if I did it all correctly. Okay. Accumulated buildings, depreciation, improvements, land, landscaping, all zero. Perfect. That's just what we want. We know those amounts are correct. Okay, so next we need to book the rest of the things that we see on the closing statement. So we know we have mortgage on the balance sheet, and we know that needs to go to zero. That's 274, 291, 83. Two seven four 291.83. Okay. And that normally holds a credit balance, so we know that's what we need to zero it out. Now we run into something on the statement. Let's bring up that statement. Where's that statement? Nope, there it is. Yep. Okay. So we know here it's 276, 582, 27. Right. So there's a difference there. So we're going to have to do a little bit of math. Let's figure that out. So we'll just do that down here. Okay, so we have the balance per the statement. We have the balance per the balance sheet is 274, 291.83, right? Minus, we're going to minus this escrow account amount. See the escrow balance on our last mortgage statement, 4,009.85, which also matches our balance sheet. Remember that? Right here. Okay. So what that means is in QBO, we owe this much, but the lender also has some of our money they're holding for taxes and insurance. So this equals 270. You do this on a spreadsheet too, so you don't have to have a calculator. Okay. So we know that's what we think is owed for our books, but the statement's a little different. So payoff for closing statement is 276, 582.27. 582.27 minus what we have in our in QBO. We'll call that well, we'd say that's net owed to lender. And that is 6,329 cents. So what is that difference? Well, that's interest. Okay, so we're going to put that in as interest. We don't have an interest account. Let's go ahead and add that. You add it in the journal entry. It doesn't like that very much. Let's add it over here. It'll let you add it, but it won't look right. Okay, I got to figure out how to get to the chart of accounts with this abbreviated menu here. Okay, so let's make a new account. Call it interest. expense and expenses, interest, yeah, interest paid. All right, cool. Back here, interest paid, and what we say it was 6,300.29. Okay, great. Let's also look at let's go back and put our gain on sale here. And gain, we're gonna have to add that too. Gain on what are we gonna call this? Sale of property. Okay. Make that another income count. Okay. So I'm just gonna drag this up here so we're looking at it the right way. Okay. So we have a sale price of 514, right? So I'm just going to put this in here. Let's just put it over here. So we have sale price 514 minus, remember we figured out our cost basis. What was that? 329,223. Yeah, I should have done that first because see now the journal entry when we saved it swapped our negative accumulated depreciation. Put it over on the debit side. Okay, so that equals 184,777. Makes sense, right? Sale price minus our cost. And so we're going to put that right here. Of course, it's income. Could be a loss too, so that would go the other side, the other way. Different account. So that's our gain on sale. Okay, we have our mortgage. We're closing out with interest. What else do we need to do? Let's take a look. Our closing statement. Okay, let's close out our escrow account. Forgot about that. So we included that in our balance calculation. So that's a debit balance, right? So this will be a credit. If I do this, that'll show me, if I was trying to compute and get to that payoff, I could do it that way, but let's actually just put it over here. Okay. That zeros. Okay. And then what else do we have? We have property taxes. We don't have that. Let's just say taxes. It would be something different, but that's fine. And 1863.06, this is a credit. Taxes prepaid. And a seller credit. So we're booking this from the seller side, of course. The buyer would have their own side. And then closing costs. We definitely do want to account for this. Let's go ahead and create it. And you could have more detail on closing costs if you want. Commissions, title fees, etc. Let's just make it legal and professional. Okay, closing costs in, what is that? 22,831.47. Great. Okay. And we have a seller credit. Let's make that account. And what will we make this? I think probably what I would make this is, let me see, something like, hmm, oops. Okay, so we're adding seller credit. Yeah, we'll just make it an other expense. Okay, because this is something paid due from the seller at closing. An expense. We know this is 15,000. Okay. And I think we have everything else other than cash to seller, right? See if I missed anything else. Yeah, we got that. Okay, so let's just say that this hit the checking account. And 201,449.32 matches. Perfect. So we know we did everything correctly. Let's go ahead and save this and refresh our balance sheet. Take a look. See what this looks like. Bring up the P&L too. Okay, balance sheet, checking account has that. The proceeds, if we were to open it, we'd see escrow is 0. That's correct. We know our fixed assets are all zeroed. Our mortgage is 0. Exactly right. Let's look at the P&L. Didn't I load the P&L there? Okay, maybe not. I may suffer from short-term memory loss. Hard to remember if I do suffer from short-term memory loss. Although it's going to slip into the long-term memory if this doesn't load. I think I might celebrate a birthday while this is loading. Have to get a haircut. Okay. Let's take a look at our P&L. What were we looking for? Closing costs? Yep. That shows up. Interest paid? Yep. What else do we have? Taxes? Yeah. Of course, showing negative because there wasn't anything already entered in there. But that would just reduce the amount of taxes that were actually paid. And then there's our gain on sale. And there's our seller credit. So everything is correct per our closing statement and our mortgage statement and our balance sheet and our P&L. That's how you do it.